Okay, cool. So whenever you're ready, take it away. And again, 15 minutes to pitch and 10 to 12 minutes for Q&A. You can go ahead whenever you're ready.
Andy, good to go?
Thank you. Yeah, thank you. Good afternoon or good evening to those in Europe. We are London Business School Team B with credit pitch on one of Bank of East Asia bonds. We are Nicolas Tio, Tobias Farmé, and myself, Andy Núñez. Can we go to the next slide, please? Okay. Our credit pitch is Bank of East Asia 5.825 per, which we recommend as a strong buy with a target price of 107. We think that market is overly bearish on our bond, and this isn't justified because of three reasons. First, Bank of East Asia has less exposure to Chinese property market than its competitors. Second, Bank of East Asia shows a strong prospect of profitability given its declining credit costs and improving asset quality. And third, Bank of East Asia has a stronger capitalization ratios than those of its peers. Going next to the next slide, please. Thank you. Starting on the macroeconomic level, on the left-hand side, we see drastic changes on long-only fast exposure to China after Evergrande issue. At the same time, option-adjusted spreads for Asia financials has widened significantly, including for seemingly unrelated companies, and justified as we think. My colleague Tobias will focus on the company-specific aspects.
Thank you, Andy. Having covered the macroeconomic part and established our view that the property sector in China is just too big to fall, the company specifics are also very interesting. Bank of East Asia is a well-established bank in Hong Kong, evidenced by its assets and its pre-COVID EBT. It's also domestically, or the SIP essentially, which is a very important bank by the Hong Kong Monetary Authority, established essentially since 2017. And what is noteworthy in this regard, as you can see on the left-hand side, is that the medium-term strategy of our bank is essentially moving away from risky assets in mainland China. Over the past years, we have seen a decrease in its total exposure. Next slide. Again, due to its very strong market positioning in Hong Kong, Bank of East Asia has, over the last couple of years, managed to generate very stable and high quality PPOP, so pre-provision operating profits. The forecast points also point into a very positive direction. So over the next couple of years, it will increase again after having suffered a dent due to COVID mainly. The net interest margin, which has been reduced for all banks in the entire world, essentially due to the very low key policy rates, we believe has bottomed out this year. And in the next couple of years, will continue to increase again when rates will be increased in Hong Kong as well as globally. So there is potential upside. Loan growth in general remains to be constant and is actually increasing a lot in Hong Kong, while, as I showed previously, is decreasing in mainland China. Moving on to the funding structure of our bank, we can see here very well, again, it is a strong brand. It relies mostly on reliable, stable, and low-cost consumer deposits by nearly 85%. This has been similar over the past decade and even beyond. So there were no big scandals. Consumers stayed with our bank. However, on this side, what is more important is the chart on the right-hand side. The capitalization ratios are a good reflection of the prudent and conservative lending approach of our bank. So what we see here is essentially our capitalization ratios are well above regulatory requirements. The bank definitely outperforms all of its immediate competitors in Hong Kong as well as in China. We believe that this buffer prevents essentially triggering the buffer in the bond documentation. Next slide. On top of that, we've looked at the NPL ratio, and we believe that the NPLs continue to decrease, especially in China, which is a direct result of shedding assets, especially legacy corporate loans that in the past couple of years have turned out to be problematic. We expect that the NPA ratio in general will be closer to the current NPA ratio of Hong Kong, which is at the bottom of the chart. On the right-hand side, we see the breakdown as a percentage of total loans. At the first look, it might be concerning that our bank has exposure at 12% to the Chinese property market. However, we did more due diligence on the customers in this area, and we identify that it is not low credit quality, but rather high credit quality customers. Only a very small portion of those are problematic. Next slide, please. To get the full picture, we've also conducted an ESG analysis on our bank. Two things are noteworthy. On the left-hand side, we see that our bank has limited exposure to environmentally intensive industries. This is in line with the Chinese government policies. They would like to invest in different sectors and move away from coal and polluting industries. And on the right-hand side, we see a very, very strong track record of credit positive prudent management style that was evidenced by the previous slide, so our high capitalization ratios. My colleague Nick will now talk a little bit about, amongst other things, the valuation.
Thank you, Tobias, for showing us Bank of East Asia strong fundamentals. So now we'd like to take a step further and present the results of our stress test on the bank. So using PPOP, loan loss provisions, as well as capitalization ratios above regulatory requirements as our total buffers, and assuming a 1.5 increase in nominal NPLs. So as shown on both data tables on the left, Bank of East Asia still enjoys a very comfortable buffer. Hence, it's extremely unlikely that the Bank of East Asia perps will be triggered and converted to equity or any sort of write-down. It also wouldn't be a credit pitch, if we didn't consider any downside risk. So Andy and Tobias has really covered some of the risks that we've identified here earlier on. But perhaps what's obvious, the elephant in the room is how Bank of East Asia will navigate the regulatory risk or the uncertainty in the Chinese market. But what gives us a lot of comfort, is the bank's management strategy that is very in line with the Chinese government medium-term goals. So they are targeting industries such as green energy, autos, as well as tech industry. So these are sectors that are crucial to the Chinese government. So moving on to valuation, as seen in both charts, the Bank of East Asia perps have generally underperformed its peers, both Hong Kong as well as its China mega banks. So, after doing our due diligence, as well as explained by Andy and Tobias earlier, what this means to us essentially is that now is a very attractive timing to invest into Bank of East Asia perps. Specifically, the reason why we chose Bank of East Asia 5.825 and our target price for it to tighten by 80 basis or 3.3 cash price. If we were to compare between different companies, between different banks, comparing Chongqing 5.5 perp and Bank of East Asia 5.825 on the right-hand side of the chart, both of which are priced very similarly. However, we definitely prefer Bank of East Asia, the 5.825 perp, given its stronger fundamentals over Chongqing Bank, as shown in capitalization ratios and other metrics. Focusing on the charts on the bottom left, we can see that Bank of East Asia perps are historically trade about 80 to 90 basis wider than tier 2 equivalent, as well as B China 3.6 perp. So once this uncertainty regarding the property sector is over, we have reasons to believe that the 5.825 perp will tighten back towards its historical average. Lastly, between the Bank of East Asia perps, the 5.825 that we have selected actually enjoy a 127 wider reset spread than the 5.875, which is not priced in at all if we look at the chart on the right. So considering all of the above factors, we have strong conviction in our buy recommendation. So lastly, we have also included, perhaps I'll pause here for a minute, mechanics of our stress test, given the 3 buffers that I've just elaborated earlier on, as well as some data that we have collected, using public sources such as Bloomberg Capital IQ, as well as key ratios and exposure to Chinese mainland that we have calculated. So this brings us to the end of our presentation. Thank you for your time and attention. And we'll be more than happy to answer your questions.
I guess maybe if you could start off, I know you mentioned, I might have missed it, but what is their exposure to not just Evergrande, but the entire China property space?
It's yeah, at the very beginning. So it's currently at 12%, which has decreased considerably from earlier years. But this includes the entire sector. So not only property developers, but also related sectors.
Do you have any sense of what the impact on their capital ratios and reserves would be if, say, there was a market effectively is pricing in, I think, prior to some moves this week and last week, was effectively close to like a 50% probability of default for a large portion of the sector. So as you stress that portion, how does that affect the overall capital ratios and reserves?
Yeah, I would quickly try it, and then I would hand over to Nick. So what we did is essentially we tried to figure out to what the developers our bank is exposed to per se. So we did due diligence on that. So again, they're mostly exposed to high quality credit companies such as KJW Group or HIBA. However, unfortunately, in the annual reports, we don't have the exact split, so we don't know the exact exposure to it. And this is why we try to perform the stress test at the very end to see if a considerable increase in a multiple of our variables would result in either default on the bond essentially, or it would trigger the turning into equity of our bond. Nick, do you want to take it from here?
Yeah, I think what's there to add on is, in addition to the fact that the HKMA, the Hong Kong Monetary Authority, has actually asked all banks to calculate the exposure to Chinese property sector. And what they have explicitly stated is that, the Hong Kong banks are safe and, there's no systemic risk from that front. So that's something we find comfort as well. But I think what, we can actually take away from this slide is actually, since like Tobias mentioned earlier on, the Bank of East Asia, actually the management has actually actively shifted away from such risky exposure and loans. They have actually written part of this down in 2019, in 2020. So that kind of gives us comfort that they have already started to shift away from this, as early as 3 years ago, when there's talks about China government being concerned about the property sector, the famous 3 red lines. So I think that's something as well that gives us a bit more comfort in terms of the credit selection. So to address your question a bit more directly, like in this particular stress model, we've actually assumed like 150% increase in the gross nominal sort of assets. And even when the nominal increased by about 10 billion sort of portion, the amount, there's still 4.6% sort of buffer above the regulatory requirement. And when we did sort of testing, these have to increase to like almost like 300% before the buffer reduces like to just at that level. And that will mean like, essentially like 30-40% of the entire portfolio defaulting. And this excludes the collateral of 30 to 40% that's being included in the annual report. So we think that this is a very unlikely scenario, and the government would have stepped in to provide like 30% of higher quality corporates, property companies defaulting.
Yeah, hey guys, can you hear me?
Yeah. Hi, Michael.
Hey, how's it going? It's just a general question for you. How long do you think it takes for this trade to play out? Is there a catalyst on the horizon that are going to get people comfortable that there's not this systemic risk here, or just in general that things are contained?
I think this is really a $1 billion question, like, or rather $400 billion question if you consider how the whole Evergrande situation is going to play out, right? So I mean, just as early as today, we have read like FT reports on the Chinese government getting the founder to sell down his assets. So honestly, I think none of us have a question on this, on how long it will play out. But from our point of view, we don't think this will last more than 3 months. because that would be really detrimental to the Chinese economy. So, but I'm sure what's on the regulator's sort of mindset right now is how they plan to resolve the Chinese property sector in terms of, whether they plan to write down Evergrande, prevent sort of systemic risk. I'm sure, they're all cracking their heads over this. But generally, that's also why we set a 1 year target instead of like 3 to 6 months, because honestly, I don't think anyone in the market can really forecast where this will go. Yeah.
Hi, it's Ricky here. Now I understand you said they didn't show any name by name exposure through China crop, but have you kind of, in your analysis, have they shown kind of geographical tier 1, tier 2, 3, and 4 type of breakdowns, whether it's in the greater Bay Area or other provincial towns? Like, have you looked at that and how you feel comfortable with that in terms of that exposure? Because obviously the disclosure is lacking in terms of your exposure through single names, but just from maybe a higher level exposure within China. Yeah,
I think that's a very fair point. We have actually reached out to the IR, but unfortunately, we didn't get any reply from them. But based on our understanding, there have been similar questions that was raised in past earning calls, and they have historically mentioned that they are prudent. They have focused on generally, like you mentioned, the Greater Bay region, the Delta River, the tier 1, tier 2. They generally say that they're not comfortable with those property developers in tier 3, tier 4. But that's as far as we can get, in terms of public documents that we can source from.
I have an unrelated question away from China property. I mean, you obviously picked a perp, so have you given consideration to the back end floating and how comfortable you are on that exposure in terms of taking on a perpetual with the coupon at the end?
Sorry, so if I understand your question, do you mean like in terms of default, write down, or in terms of the extension sort of risk if they don't call back the bond?
Yeah, extension risk, what the back end looks like, because you have seen, in bank perps, when it extends, when you get extended, it's painful. So
yeah, I mean that's definitely something that we have considered, before picking this particular bond. But I think what's unique in the Asian sort of bank market is none of them have actually not called back or at the first call date. So for Bank of East Asia to not call its bond for whatsoever reason will really leave a blemish on its bank, which is something that we believe it will not want to do. And I believe earlier this year, they do have a tier 2 bond or the perp that was being called back. Even though technically, if they were to let it roll, it will enjoy lower financing. And I believe in some particular address to investors, the IR mentioned that I believe they are not able to explicitly state before they call back the bond that they will call back the bond. I believe that's not allowed by the regulators, but they have publicly stated that they will perform according to market expectations. So that's something that we think highlights the will of the company. And in terms of the ability of the company to choose whether they want to call back the bond. So I think this slide really shows everything. That's besides 5.625 perp that's maturing, I think, in about 6-7 months time, which is like $500-600 million. Like what we can see from this chart is there's actually no urgency for them. They have no senior unsecured like bonds or whatsoever that need urgent refinancing. So, and they are way above the regulatory capital ratios anyway. So we think that they definitely have more than the ability to call back if they want to. And like I've explained earlier, I think they are very willing to do so as well.
Thank you.
Thanks, Ricky.
And are these cumulative or non-cumulative? Do you know?
Sorry, I didn't get a question, Andrew.
Are these perpetuals cumulative or non-cumulative?
I believe they're non-cumulative.
Okay.
Yeah.
I guess, going back a little bit to the prior question, do you feel like you're getting paid enough here? There's obviously, the extension risk where,
Yep.
If rates don't go your way, you might get hurt on the reset. It is a shorter call. It looks like the upside case is just a couple points here. You would also, from a credit perspective, run the risk of that non-cumulative feature in the perpetual, which would be likely worse of a situation than just the reset extending. And those are obviously coupons you would not get paid back. Was this kind of the most total return instrument to go with your thesis, or how do you kind of think about that total return component? Because I'm not seeing a ton of upside from the way that I'm looking at it.
Yeah, I mean, I definitely agree on you that this is like not a single B sort of name, or not like a triple C where you can get like 15, 16 sort of % of total return. But one of the comfort that gives us is that, like Tobias had mentioned earlier, this name is a really quality one, and we think it's just unfairly punished because of the reasons that we have mentioned above. So that kind of provides an attractive entry point. We did think about pitching about some property names and that, but we came to the conclusion that from the day that we prepare to prep this competition, we could have prepared it, but we need to throw it out the window because things are evolving so fast. So we picked something that makes sense to us, very attractive historically, and it's something that we can safely put our money in and say that you'll generate pretty good returns.
Yep. And what was the spread widening in the senior bonds, roughly, for something that's a little bit longer out there yield curve?
Okay, so the funny thing about Hong Kong banks is, not the funny thing, but because they are kind of safely funded by deposits, most of the Hong Kong banks don't have any senior unsecured. But if you were to take a look at this particular chart on the tier 2, it hardly moved much. So that was the reason why we decided to pick the perp over the tier 2 as well.
Okay.
Yeah.
It looks like we are just about at time here.
Yep.
So thank you, London, for a wonderful pitch. We will put you in the breakout room where we ask that you stay logged on.